Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. MRF charts new history on Dalal Street, becomes the first stock to cross the 1 lakh rupee mark, rallies nearly 50% in 1 year. We bring you analyst views on where the tire company will drive to next. Small and mid-cap star in trade today hit their all-time highs. Benchmarks also end higher. Sensex up 419 points, Nifty up 115 points, closing above 18,700. Big challenges for economic policymakers as private weather forecaster SkyMet predicts a bleak monsoon. Business Today TV talks to top economists to see what impact low rainfall could have on the economy. Maruti Suzuki is set for a big bang MPV launch next month, announces Invicto, which could be a rebadged variant of the popular Toyota Innova Hycross. Bad news for employees and startups as valuations of big boys like Byju's, Meesho and Swiggy being sharply slashed. ESOP values are also tumbling. BTTV tells you the impact on those lured by ESOP. U.S. monthly core inflation falls to 4%, giving room for Fed to pause rates. U.S. inflation rate at a 2-year low. MRF has set a new record on D Street. Shares of the company rose nearly 1.5% in trade today to hit a lifetime high of 1,440,000 rupees on the NSE. The Chennai-based tire manufacturer has become the only listed company in the country to cross the 1 lakh rupee mark. By the end of the trade, stock was up more than 1,000 rupees and closed just 8 rupees shy of 6 figures. Incredibly, the stock has given a 46% return in the past 1 year. My colleague Sakshi Batra spoke to market analyst Shailendra Bhatnagar and started out by asking him about the rally as well as all the action in the trading session today. Listen in.
So, Sakshi, there are a couple of things that are working very well for MRF. If you think it's a 50% return from 1 year ago, in this century alone, suppose we take 2000 as the starting point, I'm sure you must have been in third or fourth standard then. From then on till now, the stock has been a 100-bagger, which means that MRF in 2000 was quoting at 1,000 rupees. And in 2023, it's at above a lakh. So it's gone up 100 times in a span of 23 years. And primarily the reason behind that is a very low liquidity in the stock, which basically means that one, the price ticket is very high. So retail investors generally don't come in. And institutional investors are, from what we've heard on the street, very clear in the mind. Of course, the management also takes a lot of feedback from the market, and they're very clear. Don't split the share, don't reduce the face value, stick to what it is, ensure that there is little liquidity as possible, so that because of the lack of liquidity, the stock keeps on, have that additional momentum to go higher and higher, higher and higher. So in 2012, it was at 10,000, 2014, it was at 25,000. 2016, 15,000, 50,000, 2018, 75,000, and 2023, we are at 1 lakh. Let's see what happens in 2030.
Right, absolutely. But, are you actually now looking at a 2 lakh rupee target at all? Is that still feasible to think, or is it still a very, very far off thing that one can imagine?
So, Sakshi, 2 points really. I don't think so. This is a point to enter the stock. Let's be very, very clear. The market is very, very overheated, and end of the day, MRF has an excellent brand, but it's a little on the higher side as far as valuations are concerned. But for those who have the stock, absolutely do not exit, and those who wish to buy, even at these 6 digits, I would just say wait and let it correct a bit. If it does, you're lucky. If it doesn't, then well, you were never a part of the rally and you never are. So what can be done? But I don't think so. This is the time to jump onto the bandwagon. It's extremely overheated. If you look at, the momentum, the price is above short, medium, and long-term moving averages. We've seen increasing volume, but it's very, very risky unless you're a very smart trader to come into the stock.
That's very true, Shell. But like you pointed out, Shell, that the stock has, the company has never given out a stock split or a bonus. Of course, dividends is what we have constantly seen. But going forward also, even as the company goes more expensive from these current levels as well, one cannot hope for that. And you did say that, of course, this is not the right time for investors to enter. But for those who already have this stock, is it the time to book profits?
Sakshi, the entire edifice of MRF has sort of been built on lack of liquidity. You would be surprised to know there are only 42 lakh shares in the float. So, and if you just look at how the data is, the top 6 institutional holders in the quarter that's gone by, say between December and March, 5 of them have actually increased their shareholding. Which basically means that, more and more liquidity, whatever is the minimal float left in the market, has also been slowly sucked out. So my suggestion or my thought is, if you are a part of the rally, do not get off the bandwagon. Just enjoy this wonderful, wonderful ride that's coming up in front of us. And if you don't have the share, I don't think so. At 6 digits, it's the time to.
While MRF leads the list of pricey stocks in India, there are stocks globally with stratospheric prices. Let's take a look. Top of the charts, Berkshire Hathaway, led by the iconic Warren Buffett. It's at 4 crore 19 lakh rupees. Next is 178-year-old Swiss chocolatier Lindt, whose shares are at a whopping 1 crore 3 lakh rupees each. British clothing major Next, also on the list, with shares trading at more than 6.5 lakh rupees. Meanwhile, construction major NVR, agri and transportation conglomerate Seaboard, travel planner Booking, also high up on that list there. Shares of AutoZone and restaurant chain Chipotle, as well as insurance major White Mountains, are between 1 and 2 lakh rupees. Benchmark indices closing higher now for a second session, the Nifty ending above 18,700. Earlier, while markets opened in the green, tracking positive global cues as well as a good start on the back of CPI inflation and IIP numbers released on Monday, the mid-cap and small-cap indices on the NSE hit their lifetime highs during trade. Sensex was up over 400 points today, Nifty up over 100 points. Top gainers, Tata Consumer, Cipla, ITC, Titan and Asian Paints. On the flip side, Kotak Mahindra Bank, Adani Enterprises, Adani Ports, HCL Tech, M&M lagging behind somewhat. It could be a very challenging year for economic policy makers, with monsoon likely to play hooky this season. Private weather forecaster Skymet has warned of a parched heartland in the grain bowls of India. A warning, if it comes true, could be devastating for the agri and rural economies of the country. Business Today TV Managing Editor Siddharth Zarabi spoke with 2 eminent economists, Shaugata Bhattacharya, Chief Economist Axis Bank, and Siraj Hussain, former Agricultural Secretary, to gauge the impact of a truant monsoon.
It's been delayed by 1 week. Kerala usual date is the 1st of June. It started on the 8th of June. And the extended range prediction system, ERPS, of Skymet is predicting a dismal outlook. What's your own sense, given your vast experience of tracking the monsoon showers, sir?
You see, from the very beginning, it was clear that this year El Nino effect is going to have an impact on the monsoon rainfall in India. And the first forecast of both IMD and Skymet reflected that. Then the IMD's second forecast came, which sort of projected a better monsoon, some kind of normal monsoon, which was a little surprising. So I wrote an article for Deccan Herald in which I explained the IMD's forecast, because I thought that despite all the experience and knowledge gained by IMD, the monsoon science is still not perfect, and therefore sometimes the predictions can go wrong. In case of short-term predictions, like the one which has been issued by SkyMet today, we can believe that it is going to be more reliable. So I think for the next few days, we should prepare for shortfall in rains. However, for the longer term, my own sense is that despite the IMD's forecast, we should prepare for shortfall in rains due to the impact of El Nino.
Okay, that's a very important nuance that Mr. Siraj Hussain has offered us viewers. He's making 2 points. One, the fact that the IMD gave a second forecast which was kind of different from the earlier one, but you know, it's science after all. But the more important thing, Shogato, and I'm coming to you, is the distinction that Mr. Hussain sort of drives into our discussion, which is be prepared for a short-term shortfall, but in the long term things may well change. Is that how you also read his comment?
Yes, I agree. I mean, Mr. Hussain has enormous expertise on this. So I completely agree that the first thing, if assuming that the SkyMet forecast for the next month is correct, that rainfall there is a shortfall in rains and a bad spatial distribution, which is the most important part. Bad spatial distribution with a large, the central India, West India, North India, these are the main crop growing, the kharif crop growing areas. So one thing, the government has already advised farmers to delay sowing. So that's one thing. So if rains begin to pick up, it will still mitigate the impact over the kharif sowing season. It will not be a complete disaster if the rains set in. But there are too many imponderables at this point in time. The good thing in all of this is that with rains, there is definitely likely, with the shortfall and a bad distribution of rain, there's going to be an impact on food grain output. The good thing, which is, I mean, in a bad scenario, the good thing will be that Indian agriculture has now diversified significantly out of food grain, I mean, into animal husbandry, into horticulture, other products, etc., millets, bajra, which are much more resistant.
From a policymaker's perspective, last 3 years, constant challenges, a new surprise coming up. It was COVID, then it was the recovery and how we saw divergence in the economic recovery, then Ukraine, and who knew people were looking up the internet to find out what is this country that supplies over $1 billion worth of sunflower seeds to India, you know, things that were not perhaps in the mass domain. Your own sense that could a deficient monsoon play spoil sport with that sense of optimism that we are seeing in several sections of the economy?
I do not think so. I think we have the wherewithal to tackle even a bad monsoon. Of course, how bad, you know, we do not know how bad it is going to be. But supposing it is 3 or 4% shortfall in rains, I think we would be able to handle that. You know, even in a year of normal monsoon, for example, last year, the monsoon was 107% of long period average. But as I wrote in my article in Deccan Herald, the production of sugarcane has been revised downward 4 times in the last 1 year because of lower production in Maharashtra and Karnataka. It is not that every year, even in year of normal monsoon, things are absolutely fine in all the states. No, monsoons are always erratic in some place or the other. So I do not think it will have a very bad impact on economy. We have the wherewithal, we have the experience of tackling bad monsoon, and I am sure that my colleagues in the Agriculture Ministry and Food Ministry as well as in the state governments will be able to take care of the farmers. You see, the worst impact of El Nino and erratic weather is borne by the farmers, because they are the ones who lose their crop. Sometimes the first crop does not germinate, then they have to plant it again, so they have taken loan for the first crop. So they are the worst off. And what I want is that the crop insurance scheme and other government interventions will take care of the farmers.
Zee Entertainment today appealed the SEBI order against its MD and CEO Puneet Goenka and chairman of the SL Group Subhash Chandra. The capital markets regulator had on Monday barred the two from holding any directorship or key managerial positions in any listed company until further orders. Business Today TV breaks down the details of the crucial order for you.
Subhash Chandra, the man who brought the cable television revolution to India. He built a media empire from scratch, introducing the country to addictive soap operas. Now his own tale resembles one of those soaps where fortunes rise and fall. The Securities and Exchange Board of India, or SEBI, on Monday issued a strongly worded order against the former Zee Group chairman and his son Puneet Goenka, who is the current MD and CEO of the company. SEBI has accused the two of abusing their positions in the company and siphoning off funds for their own benefit. Consequently, the capital markets regulator barred the duo from holding the position of director or key management personnel in any listed company or its subsidiaries until further orders. While the order is an interim one and has been challenged, the implications could be far-reaching, including the likelihood of Puneet Goenka having to stay away from taking the top job at the merged Zee Entertainment and Sony Pictures Network India combined. The order states that Subhash Chandra and Puneet Goenka used fixed deposits worth 200 crore rupees of Zee Entertainment to repay loans of certain entities. These include 7 that were either owned or controlled by their family members. According to SEBI, at least 143.9 crore rupees were transferred from Zee or other listed firms of the SL Group to falsely portray repayments of dues to Zee Entertainment. More importantly, the decision to use the fixed deposits was taken by Subhash Chandra, who issued a letter of comfort without the knowledge of the company's board, and only a few in the management were aware of it. In the regulator's words, Chandra and Goenka abused their position as directors and key management persons of a listed company for siphoning off funds for their own benefit. The matter dates back to November 2019, when SEBI started investigating concerns raised by 2 independent directors of Zee, Sunil Kumar and Niharika Vora, who resigned from the board. One of the concerns was related to appropriation of certain FDs of Zee by Yes Bank for squaring off loans of related entities of the SL Group. In her resignation letter, Vora said that in a board meeting in October 2019, it was brought to light via a letter from the concerned bank that guarantees have been given to a subsidiary without approval from the board. She added that the operating team treated the issue very casually. Here's how, according to the SEBI order, the deal was executed. In September 2018, Subhash Chandra, the then chairman of Zee and the SL Group, issued an LOC towards credit facilities availed by certain group companies from Yes Bank. Thereafter, based on this LOC, Yes Bank adjusted the 200 crore rupee FD of Zee against payment obligations of 7 entities. Pan India Infra Projects, SL Green Mobility, SL Corporate Resources, SL Utilities Distribution Company, SL Business Excellence Services, Pan India Network Infravest, and Living Entertainment Enterprises. All 7 entities were either owned or controlled by family members of Subhash Chandra or Puneet Goenka. Interestingly, when questioned by SEBI, the company stated that 200 crore rupees, equivalent to the value of the FD that was encashed by Yes Bank for the dues of the 7 entities, had made its way back in September and October of 2019. However, for SEBI, this amounted to a violation of its rules, since the two issued an LOC on behalf of the company without informing or consulting the board. Further, a detailed analysis of bank statements showed that the money repaid to Zee actually originated from the company itself or other listed firms of the SL Group. The SEBI order says the funds followed a circuitous route originating from Zee and other listed companies of the SL Group, passing through various entities owned or controlled by the promoter family, and ultimately ended up with Zee again. According to SEBI, the flow of funds clearly indicated there was no actual net receipt of funds by Zee, and these were merely book entries to show receipt of funds. While Chandra and Goenka have moved the Securities Appellate Tribunal against the SEBI order, its share plunged by as much as 6% in trade. Interestingly, the SEBI order states that Chandra and Goenka had filed an application to settle the case, which was rejected by SEBI, who decided to examine the matter further. Meanwhile, given that the Z promoters have less than 4% in the company, Sony could still push ahead with the merger, but without a SEBI-barred CEO at the helm. Bureau Report, Business Today Television.
The past few weeks have been marred by news of startup valuations being slashed by venture capitalists and investors. Swiggy's valuation was cut by Invesco, Byju's was slashed by BlackRock, and Meesho's was reduced by Fidelity. Now, these cutbacks are also expected to translate into lower returns from ESOPs, which were used as a means by these companies to attract top talent. Business Today TV's Akanksha Chaturvedi joins us with more on this. Akanksha, how will the valuation cuts impact employee ESOPs? What have you learned?
Well, in very simple terms, ESOPs are basically equity in the company in which the employees are working. This is granted to them in the form of remuneration by the company. So what happens is, at the time when the ESOPs are granted, they're granted to employees at a rate which is called the strike rate, which is usually lower than the market rate at that point in time. And moreover, the ESOPs, the strike rate of the ESOPs depends on the valuation of the company at that point in time. So what's happening here is, in normal due course of time, it's expected that once the ESOPs have vested, employees can go out and sell the ESOPs at their strike rate. And since the market rate is, of course, going to be higher than the strike rate, the difference between the market rate and the strike rate is the employee's profit. But now, in situations like this, where the valuation of the company has reduced, it's most likely that when these employees go out with the strike rate at which they had received when the valuation was high, and when they try to sell their ESOPs, the difference between the market rate and the strike rate is not going to be as much as they were expecting before at a higher valuation, which means their monetary benefit and profit is also going to reduce. So that's how the valuation of ESOPs has changed with the devaluation or the reduction in the valuation of these companies.
How do you think employees are likely to react to this, Akanksha?
Well, there are two likely scenarios in which this is going to play out, at least in the short term. For starters, it's going to be extremely difficult to retain talent which is already working at these companies. It's because these employees had a set monetary figure in mind when, they had gotten these ESOPs. They thought that this is the amount of profit or monetary benefit that they're going to get out of the vested ESOPs. But that's not going to happen when they're going to cash it out, at least in the near term. The next issue that's going to happen, like you just said some time ago, is that ESOPs were a means to attract top talent. And if the ESOPs or the monetary benefit out of ESOPs is not as employees or outsiders or the top talent thinks it is, maybe they would not be more willing to work at these companies. So, yeah.
All right, thanks for that, Akanksha. Now, there could be good news for those in the line for H-1B visa. Silicon Valley tech giants, including Google, Meta, Amazon, Microsoft, and Salesforce, are lobbying President Biden's administration to increase the number of temporary foreign workers allowed in the U.S. through H-1B visa program. There are, however, forces working against this demand as well. Business Today's Danny DeCruz explains.
A Silicon Valley trade group called Compete America has sent a letter to the Department of Homeland Security saying that the current cap of 85,000 H-1B visas per year is insufficient to meet the demands of these tech companies, and this particular visa has always been an option for seeking skilled workers from countries like India. But the tricky part is that the demand to expand the allocation comes just months after the big tech companies fired thousands of employees. Now, there are some concerns in the US that this move will replace higher paid domestic workers with lower paid H-1B visa holders. Some companies have reportedly already started replacing fired employees with H-1B visa. One of the main issues the H-1B visa program is that it can lead to a reduction in wages in the tech industry. This primarily happens because the companies can pay foreign workers below the local median wage, which ultimately also leads to concerns about unfair competition. And it is not all good for the visa holders as well. The Economic Policy Institute claims the competition not only leads to underpayment of foreign workers, but also that these employees are trapped with the company. They are not able to challenge or negotiate for better working conditions or higher salaries due to the higher competition.
All right, Danny, thanks so much for joining us with that. That's all the time we have on the show tonight. Thanks so much for watching.